Hey everyone, my name's Andy. I'm with the Finding Value Finance channel. I'll be your host today. We've got Justin with us from the Uranium Insider. Thanks for coming on, Justin. Really appreciate it. Like having you on the channel, getting all your feedback.
Hey, it's my pleasure,
So,
Andy.
what what news in the uranium market do we have coming up here? What's going on? What's your opinions on it? What are you seeing? What's important? What's not important in the uranium market?
Well, the news that really kind of moved the sector yesterday, the sector pulled back a little bit, but we had a decent run last week. And honestly, the whole sector's been on a pretty positive move for a number of months, just generally kind of grinding higher. I was looking at the last time we talked, at least on record, and that was early May. So it's been 4 months since the last episode we did, and I actually started to watch our last interview the first couple of minutes, and the first thing we talked about was how bad sentiment was.
Mhm.
So that's shifted pretty profoundly to the upside since that moment, and most of the stocks, the benchmarks, URA, let's see, URA since that moment is up. I could just tell you really briefly, it's up about 20 to 25% since we last spoke, and some of the stocks in the space are up even more than that. And just before we started recording, we were just talking about how nobody's interested in something when the price action becomes a narrative, and that's really the time to be buying if you are convicted on the fundamental case, especially for a nice long-term hold. It's when people are panicking and complaining on Twitter and YouTube comments, and the RSI is really low. Like that's when you accumulate. But all things considered, based on the movement of the uranium price, if you chart the equities against the price of uranium, they're still very cheap. In fact, they're barely above the levels at the beginning of the bull market, which I consider to be December 2020. But the news flow recently, let's see, over the weekend, the day before, so we had the Labor Day holiday just 2 days ago on Monday, where we had a market holiday in the US and Canada. On Sunday, which is a strange day for a news release, Cameco released that they expect lower production from both McArthur River and Cigar Lake this year. So I believe it was 1.7 million pounds less from Cigar and 1 million pounds less from McArthur. They're expecting 15 from McArthur. Now they expect 14. And that's, it's not a huge amount of uranium, but it's just all of these smaller developments continue to stack on top of each other. So, 6 weeks ago, we had the coup in Niger, which is, at least for now, temporarily interrupting the development of the DASA deposit that Global Atomic owns, that the market generally is expecting uranium to come out of that deposit in 2025. So this situation is probably delaying their financing and probably going to delay their production. It'll be a mine. It's the highest grade deposit in the continent of Africa. But there was that delay. Kazatomprom's numbers came in roughly flat and even actually slightly down for the first half of the year compared to last year, even though their guidance for the year is slightly higher. So we continue to see supply fragility, let's call it. And while the demand story is just better and better and better, week over week over week. And so that's really kind of what's top of mind for me, is just continuing to recognize that the demand story is very, very strong. We have 60 reactors under construction right now. China alone has had 6 construction starts this year and possibly up to 8 more before the end of the year. Now, they need to have around 10 construction starts per year in order to meet their goal of 150 gigawatts by 2030. And they have 54, 55 gigawatts right now. So China is going all out. India just built their first of this 700 megawatt pressurized heavy water reactor that they are aiming to do in fleet mode. So they want to build another like 10 of these things this decade. The demand story is great. So, and that's just talking new construction. What really brings demand forward quickly is life extensions and Japanese restarts. So the Japanese restarts still going slow, all things considered, but slightly quicker. They've restarted 2 reactors this year. I believe there's 1 more that could restart this year. And next year, in the first half of next year, they should see their first boiling water reactor restarted, which ideally will sort of set the stage for more BWRs to be restarted in the country. But the life extensions are really, really where you see immediate demand. We saw that with Diablo Canyon, California early this year. The state of Michigan in the United States just allocated $150 million for their 2024 budget to restart the Palisades reactor that was shut down last year. We've never seen that before in the United States. So the demand story is just getting better, and it's hard to imagine another demand shock scenario. And it's important to consider that, because that's really what caused the, in a big way, what caused the bear market of the previous decade was all of the Japanese reactors coming offline after the tsunami, which caused 10% of the world's demand just gone in the course of 12 months. Even with a nuclear accident, and knock on wood here, but it's hard to believe that based on the reasoning for the rapid build out of nuclear in some countries, especially China, that would be curtailed based on a nuclear accident in another country. But still, that would hurt sentiment. It would not be a good thing. Nobody's hoping for that. But it's hard to see what would cause a drastic demand shock here. And looking at the supply, it's just the big mines are not going to be online for multiple years, and the supply is just very, very tight right now.
What's the price of SWU doing? I actually haven't looked here recently. I know SWU was just killing it. It was front running U3O8. Is SWU continuing to remain pretty robust? And do you think the uranium price is just going to continue to follow behind it?
Absolutely. Yes, it definitely is a leading indicator for uranium. And honestly, right now, I think we're starting to see the early stages of uranium playing catch up, because we saw a big move just this last month in August. Uranium was up over $4 in the month of August, which is the slowest month of the year for nuclear fuel buyers. And we're seeing decent moves in spot on lower volume. So the big moves in spot over the past 2.5 years have primarily come from financials. Sprott Physical Uranium Trust buying uranium. So that was September, October, November 21, March, April of 22. Those big jumps up in price happened on very large volume in the spot market. Now we've kind of reset after it went to $64 in April of last year. It really quickly came back to the low 50s, kind of chopped around. I think it hit the high 40s for a minute there. And then we've just been kind of grinding higher on sort of average volume in the spot market. So it's not taking this big, financially driven shock to move the price up. It's more of an organic industry supply and demand driven move. And to me, that's very reassuring, because we don't need to, even though we do track SPUT on a daily basis, along with the ETFs and, share issuance and all of that, we don't need to cross our fingers and hope for financial flows into SPUT to see the movement happen. The movement is happening without them, and it's been happening without them for months. So SWU, to answer your question, SWU, let's see, spot is $138. Long term is $148. It's yet another multi-year high just this last month. And for your listeners that don't know what SWU is, it stands for Separative Work Unit. It's basically the cost of enrichment. So SWU is one metric in enrichment contracts. That's the actual price you pay for the service. The other metrics are, of course, the tails assay, which determines how much of the U-235 isotope is left over in the tails following that process. And that number dictates how much you as a utility have to provide to the enricher. So those metrics kind of push out a price for the service, as well as how much you have to, of UF6 you have to give to them to be enriched. But SWU, the U3O8 price it bottomed and actually started to recover a little bit before SWU did, which was really interesting, because SWU typically is a leading indicator, but at the bottom of the market, it wasn't. And one reason for that is that we just had a drastic oversupply of uranium, not necessarily an oversupply of enriched uranium. So the markets are different. They're connected, but they're different. Now, once SWU bottomed and moved up, I remember talking to some industry representatives from a couple of different companies at the time. This is back in 2018, I believe, when SWU bottomed. U3O8 bottomed in 2016. And they basically, when U3O8 bottomed, they were still sort of nonplussed about it. They were like, yeah, we'll see. I'm happy to see it sort of start to recover, but I don't really think it's game on. And as soon as SWU bottomed and started to move up, because SWU from 2012 on, it did not stop falling. It didn't stop falling. Maybe it went sideways for a month or maybe two here and there, but it was a nonstop fall. So once it bottomed and started coming up, then I started to see kind of the really intelligent players in the market go, all right, you guys, it's coming now. Now it's gonna come, and not necessarily next year or 2 years from now, but that was the bottom as far as they were concerned. So yes, the SWU price and the conversion price, as well as EUP and UF6, the products of those two services, those prices moved up very steeply last year, right? So here, let me bring something up in the background, and I can actually share with you these numbers because I think it's worth sharing. But these numbers are always indicative of where uranium is going to go. This is something we've been saying over and over for the last year. And now, let's see, now that it's here, we're seeing uranium start to move after very big moves in conversion and enrichment over the past 18 months. So let's see here. I've got it pulled up in the background. Okay, U3O8 spot price August month end was $61.10, up almost $5 a month of August. Long-term contracting price jumped up $2 to 58 a pound. And that's, of course, that's just the low offer of the month and kind of the place to start. Nobody's signing actual long-term contracts at 58 bucks. UF6 was up $5 in August to $193.50 per kilogram. Conversion was unchanged, enrichment was unchanged, but SWU, long-term SWU did jump up. Okay, so since January 1st of last year, spot conversion is up 154%, long-term up 69%, spot enrichment up 135%, long-term up 118%, and now look at uranium. Spot is up 45%, long-term up 55%. So spot uranium is lagging spot conversion and enrichment by a factor of 3. And that's basically utilities secure the back or the farther end of the fuel cycle first. So if you're in a more urgent need for material, you're going to try to buy enriched uranium. If you can't buy enriched uranium, you're going to buy UF6 and have it enriched. If you can't buy UF6, you're going to buy U3O8 and buy conversion. So they're going to secure the conversion and enrichment first and then buy the uranium. That's not even to mention the enrichers buying uranium to have it converted to overfeed centrifuges. It's all coming together and pointing towards more demand in uranium. And now we're seeing big moves in the spot price on relatively small amounts of volume.
Do you know that dynamic between SWU and spot price last bull market? Do you know, like, if SWU ran first, U3O8 came behind it, did SWU turn first and top last bull market?
Did it start turning down before U3O8 did? I believe so. I actually have a chart of this. I should have had it ready. So my apologies, Andy. Let me see if I can bring that up in the background here as well. And if I can pull it up, I can even share it. SWU did move in a similar manner, but U3O8 overshot drastically more than conversion or enrichment. And the reason for that was because we had a bunch of hedge funds and Uranium Participation Corporation buying uranium. They weren't buying conversion or enrichment, right? So they're all sort of related. They all sort of move in lockstep, even though they're technically separate markets. But yes, they did move similarly. And I'm still trying to find that chart because I actually charted this myself a few months back. I apologize. I don't have that off the top of my head here, but yeah, they did move quite similarly in the previous market. But like I said, uranium overshot substantially more because the financials went after that. It's probably going to happen again too.
Is that a sustainable thing where U3O8 overshoots SWU? That can't be sustained, can it?
Well, the metric that you'll typically look at would be U3O8 spot overshooting U3O8 term. So looking at, the way that spot moves relative to SWU is not necessarily indicative of anything in this particular market, especially when it comes to the investing side of things, because you could actually see more enrichment capacity come online, and that wouldn't necessarily affect uranium. In fact, it probably would actually be bullish for uranium. If we saw more conversion come online, that would probably affect the price of conversion, but it would mean more uranium, more conversion, more uranium. And when we're in a deficit, we're going to see demand on uranium, regardless of what conversions we were doing.
Okay, so looking at this, we've got the spot price really starting to move up. We're at $61, starting to go to the upside quite dramatically. we've got the equities that are starting to break out here, at least from what I can tell. Do you think they're going to get any big pullbacks along the way? Do you think this is going to be an easy ride where, if you look at previous bull markets, the uranium spot price really took off to the upside and didn't really get too many pullbacks, at least looking back at the charts. Do you think we're going to get some pullbacks? Do you think a lot of these equities are going to get some big, violent swings as we move higher going forward?
There's always violent swings in this market. That's just kind of the name of the game. I mean, just noticing the charts right now, there is kind of a renewed underlying strength here, even on days like today, where you had the S&P down almost, over 1% intraday, and the Q is down over 1%. You had the dips being bought in the uranium stocks, and that's not something that happened in these sort of washout days before. But anything's possible. We could go risk off. I've actually been saying the same thing to our paying members over the past few weeks, is like, when your confidence in something is very, very high, playing out in the mid to long term, you almost want there to be a washout in the short term. And that's kind of where I'm at now. I think we're going to see a very strong Q4 for uranium stocks and uranium, and the price of uranium as well. So if we have a washout in the broad market, I mean, hopefully they just kind of turned over today. Hopefully that continues for another week or two at least. That should affect us at least a little bit, unless and until there's big jumps in the spot price. I don't expect big jumps in the spot price with risk off markets, because the really big jumps tend to come from interests that are outside of the industry players, right? So outside of the traders and the utilities, or even the producers at this point. So if SPUT is kind of hamstrung and Yellow Cake goes back to a deep discount to NAV and they don't exercise their option, we probably are going to see a pullback. I expect it to be a higher low for uranium equities, but I can't predict the future when it comes to what the broad markets are doing. And apparently a lot of people can't either, because the shorts have been absolutely roasted this year, myself included. I keep playing around with these short-term put spreads, going out 3 or 4 months. And I had some great trades last year on that on the S&P. And this year I just, they're not working. So hopefully they work now, and I can put a little bit more cash into my longs, which is basically, uranium, oil and gas services, and precious metals, really. But for the most part, I don't really know what to expect from the broad market. It's kind of above my pay grade to make that type of futuristic prediction. All I can do is understand the fuel cycle for the uranium trade. Look at the charts for the uranium equities, and the charts look very nice. They're a little bit overstretched right now, but not to the extreme. Are they due for a little pullback? Absolutely. I'd love to see it rest here. Sideways chop, pull down 5 or 10%, reset the RSI. Bob's your uncle. Because right now what we have is the WNA conference happening in London. And that's a huge event where all the industry players come together. There's a lot of excitement around nuclear and around uranium right now. This is an annual event. And what's happening this year, in fact, it's going to be released tomorrow. We're recording this on Wednesday, the 6th. Tomorrow, Thursday, the 7th, they're going to be releasing their biannual nuclear fuel report. And this is that classic chart we've all seen, with the kind of, the background of the chart is like the color of my shirt. You've got these big alligator jaws of supply and demand, essentially. And they put out 3 different charts. They put out a lowercase, a reference case, and an uppercase in terms of demand. And there's different assumptions baked into those different cases, right? So in the lower assumption, in the lowercase, you'll assume that reactors are going to be shut down on when they are set to be shut down, right? So, for example, the Perry nuclear power plant in Ohio, I just visited this plant last month, or excuse me, in July. They just filed for a life extension. So the lowercase would expect they don't get that life extension and it shuts down later this decade. The reference case will be, some life extensions, some shutdowns. The uppercase is like a lot of life extensions. And there's other stuff that's baked into that, but just kind of putting it simply, the market is definitely kind of waiting with bated breath to see this new updated fuel report. I personally think that the reference scenario this year is going to look like the upper scenario from 2 years ago, because so much has happened in the sector over the last 2 years. It's even hard to believe when I think about all the developments. But we're talking about higher operational and transactional tails assays, massive momentum around SMRs, which remind me to talk about that in a second. Japanese accelerated life extensions, China doubling down, South Korea doing a 180. the UK doing a 180, the US supporting life extensions for nuclear and potentially new nuclear. I mean, I could go on and on and on, but there's 30 something countries that are looking at new nuclear right now. It's just phenomenal. So I think this graph is going to be quite shocking to the industry, to be completely honest. And when we see that and we see the kind of demand picture that we're looking at for this decade, it's really, the bet on uranium going higher here is it's very simple. It really is. I mean, it's a complex industry. It's hard to understand all the moving parts around the fuel cycle. There's a lot of data to wrap your head around to really build out a decently accurate model. But all you have to really understand is supply is significantly less than demand now, and it's going to stay that way for multiple years as demand continues to grow. That's basically it. So if you look at the commodity, it's in a bull market. The equities are volatile. They're going to do this in the sinusoidal wave and make higher highs, higher lows, higher highs, higher lows for the most part. We just come out of an 18-month consolidation after the first leg. I think we're kind of in wave 3, the first innings of wave 3 here.
So you wanted me to bring up the SMRs, small modular reactors. What's going on with them? I think a lot of people think that that these small modular reactors are many years away. So what's going on there?
Sure. There's a couple of interesting pieces of news. One is in the United States, and that's that the Nuclear Regulatory Commission is working on putting together a framework for regulating and licensing advanced reactors and small modular reactors and micro reactors. So they're trying to put together a framework on how to basically license and approve these newer designs. And a lot of these newer designs are not light water, boiling water reactors, right? They are pressurized water reactors, or gas cooled high temperature reactors. There's a molten salt cooled reactor that TerraPower is developing, et cetera, et cetera. And these are not easy for the NRC to license because it's technologies that they're not necessarily unfamiliar with, but they haven't licensed in the past in the United States. And most of the utility interest in the United States for new nuclear is around smaller reactors. And that primarily has to do with financing risk in this country. It's not the same in other countries. This is why China, despite the fact that they're going to have the first SMR built, they're going to beat everybody else to it. They're still building 26 large reactors under construction right now, right? Because they're not having to deal with the finance risk. They just say what they're going to do and then they do it. For better or for worse, right? But here in the United States, we're dealing with the last large nuclear reactor that was built here, the Vogtle plant in Georgia, that had insane cost overruns. It took way longer than expected. It bankrupted Westinghouse in the process, in which Westinghouse has been around for 80 years. I mean, they've been here since the advent of civilian nuclear. So that was a big event. And all of the utilities in the US are fully aware of this. And so essentially the thesis around SMRs being attractive in the US to the nuclear utilities that are looking at new nuclear has to do with the fact that if you can build something faster and you're borrowing money at 5, 6, 7%, you save a hell of a lot of money just by building it faster. So if you have a multi-billion-dollar project and it has a 6-month delay or a 1-year delay or a 2-year delay, that's a lot of interest that you're having to pay based on that borrowed cash. So getting things done faster is very attractive to the US utilities. And of course, even though SMRs, we're still building the first demonstration projects in the US. That's TerraPower's Natrium reactor and X Energy's XE100. And we've yet to commercially roll these things out. At least they're happening. They're being supported by the DOE and the funding from the federal government. And now the Nuclear Regulatory Commission, admittedly under pressure from multiple nuclear advocacy NGOs. So good work, guys. They're building out that framework. So, you're not going to hold your breath for the first SMR in the US, but they're moving in that direction thanks to pressure coming from the industry. And that's a really, really good sign. The other piece of news that I think is quite interesting, and I actually tweeted about this yesterday, was that there's a tender in the market for uranium in the form of enriched uranium for 2026 to 2031 delivery for an SMR, and it's a non-US utility. I'm guessing it's probably OPG building out the Darlington, the four GE Hitachi BWRX 300 SMRs are building at Darlington. They originally were going to do one. They just announced a couple months back. Now let's do 4. We're doing 1. We might as well do 3 more. So they're actually in the market buying uranium for this SMR. Which means 2 things. A, they're smart and they can see where the puck is going. So by the time they want to fuel this thing, which is probably going to be, 2028 or something like that, they're not going to want to come into the market in 2026. They're coming in now to secure that contract. So they're first movers and they're intelligent. That's my first observation from that. My second observation is that the market basically thinks that SMRs are sort of not necessarily a pipe dream. I think the market believes that this is real and they will be rolled out over time. In fact, the nuclear consultants believe the same thing. TradeTech and UxC. TradeTech is considerably more, bullish, for lack of a better word, on the development of SMRs. They think we're going to see at least 200 million pounds of uranium demand cumulatively by 2035. That's pretty significant on top of the demand that's already modeled out for the existing reactors, the expected life extended reactors, the under construction reactors right now. But still, I think that the investing community, for lack of a better word, believes that SMRs are a 2030 story, and that it's not going to matter for the price of uranium or supply and demand modeling for the next few years. And now here we have it. The first SMR, to my knowledge, the first SMR developer actually in the market buying uranium right now. So even though the first delivery is in 2026, that's locking up uranium, and that if they sign on the dotted line this year, that counts as long-term contracted pounds this year. And they also understand, that the primary producers are pretty sold out of uranium for the next few years. So we're talking about Cameco, Kazatomprom, Orano. They don't have a lot of production flexibility in the next few years. And if I apologize if I'm going on too long here, but I think this is a really important point to understand. We're at now, let's see, 121 million pounds contracted this year to date for uranium. We think we're going to hit probably somewhere in the 150 to 180. I think we're going to get close to replacement rate contracting. If things really heat up in Q4, we'll hit replacement rate contracting. It was about that 180, 185 million pound demand number. But one reason that contracting has slowed down a bit this year after the big numbers the first few months of the year, especially coming from Cameco signing a contract with Energoatom in Ukraine, is that utilities are flexing up their legacy contracts. So I'll see if I can explain this in as quickly as possible. Basically, these contracts are pretty nuanced, and there's no set way that contracts between any given producer or utility have to follow, right? So there's a lot of nuance, there's a lot of bargaining that goes into these things. But to give you an example of the type of contract we might have seen back in 2018, okay, we still had pretty low uranium prices. In fact, I think they were in the 20s at that time, spot uranium, maybe the 30s for term. And what we're looking at there is contracts signed with a producer would be probably 60% reference to the market and 40% fixed price. So what that would mean is at the time of delivery, you would be paying 60% of your costs would be paid at the price of uranium in the market at the time of the delivery, right? So if you're taking delivery for a 2018 signed contract right now, 60% of that contract, you're going to be paying 61 bucks a pound or 58 bucks a pound. I think it's the published term price is the market. But the 40% is still fixed at the price you signed. So when you signed a term contract in 2018, the fixed price was 32 bucks or whatever it was, right? I don't have the chart in front of me, but way cheaper than now. So if you're a utility and you have some level of confidence that your reactor is going to be operating out into the next 5 to 10 years, which most do, especially with all the de-risking that's happening around the world in terms of operations of nuclear power plants, you're going to flex up that contract all day long to the extent that you can. You're going to get 20% more. That was a common figure, is the 20% flex option up or down. So during the bear market, when a utility signed a contract in 2009 for $75, and then at the time of delivery in 2012, when the uranium price was $40, you're going to flex that contract down. If you're not going to declare force majeure like some of the Japanese utilities did, you're going to flex it down. You don't want to take all of that delivery because you can just go buy from the Kazakhs or the Uzbeks, or you can just buy in the spot market at the market prices instead of taking delivery on this fixed price that was way higher. So they flex down. The opposite happens when the market turns. So that's what we're seeing. Utilities, and for the past year, as we've been in a very consistent rising price environment, you're going to flex up all day long. That does a couple of things. It defers demand a little bit, right? So if you need to come in and cover your needs for, let's say, 3 to 5 years out, you might be able to delay that slightly if you can flex up a contract for 20% more uranium. You can delay that for 6 months or whatever it might be, right? Maybe by that time, the market will de-bifurcate and I can call up my buddies in Russia again. I don't know, right? But that's the way some of the utilities are thinking. The other thing it does is it tightens the forward curve for producers, because the producers have to honor that option that they gave in that contract. So for Cameco, their deliveries right now for those legacy contracts, and it's not great for Cameco either, because they're having to take more of their pounds coming out of the ground now, delivering into these old contracts and flexing those up and delivering 20% more than they had expected, and at that fixed price, which at the time is way lower than market prices now. So not great for producers currently, but it tightens the market substantially. There's no flex in the market right now. The spot market is so tight right now that average volumes are moving up $4 in August, almost $5 in August. That's unheard of. This is the slowest month of the year. The last point on flexing, I'm almost over. I'm almost done with this. New contracts being signed by producers are not including these flex options. So that's another sign. The producers say 3, 4, 5, 6, 7 years from now, when we deliver on this contract, we don't think we're going to be in an environment where we'll have an abundant enough supply that we can just give you more if you want it. So the flex options have gone away in these new contracts, and the contracts now are leaning far more towards market reference. And what that tells you is that the sellers are in control, because the buyers, the utilities, they want fixed prices. If they could have pure fixed prices, they would get it. The sellers, the producers are not giving them that. In fact, they're moving towards mostly, if not entirely, market reference with floors and ceilings. So those floors and ceilings right now, from what we're hearing, are floors in the 50s, ceilings in the 80s. So basically, it's an agreement between these two sides saying, we know the price is going higher. And if you put a ceiling at 85, both parties are expecting that it's going to go higher than 85. So the dynamics of the contracts have changed a lot in the last 2 to 3 years, and the flexing up by utilities is deferring and tightening at the same time.
Do you think it would be beneficial to be a developer right now, kind of a higher cost developer, waiting for all this stuff to play out? Or do you think it would be beneficial if you are a lower cost developer where you could sign these contracts earlier rather than later? Would it be beneficial to have a company that would wait for the price to really strengthen, or what's your opinions around that?
That's a really interesting question, because we know that the companies that are currently in the early stages of development, generally, especially if they haven't cashed up sufficiently over the previous couple of years, have de-risked that development with a certain number of term contracts, right? So they've taken in a little bit of capital in order to help with that development of that project, and sign some contracts ahead of time to do so. It's tricky because there's a lot of risk with development. Development of a mine, especially a new mine, it never goes on time, on budget. There's always problems. And so if you are risking a lot of capital, borrowing a lot of capital to develop a mine without having contracts in place, you can get stuck in a situation like we had in the previous bull market, right? So if you were, and it's sort of a hypothetical situation, because really there was only one mine that got developed, that got into production during the previous bull market, and that was Paladin building Linger Heinrich. But if you were to build a mine in a rising price environment, basically trusting that the market's going to stay stable and rising for the foreseeable future, and you will be able to sell into that, and you feel confident enough in that you don't secure any contracts, that of course, a contract you sign with the utility prior to your mine being built is not going to have the best of terms, right? It's going to favor the buyer. because they're taking a risk, spending some money on a project that might not get into development sufficiently to provide the uranium they need. So they're taking a risk, which means they dictate the metrics of that contract more so than the seller does. But there is risk. There is risk that you go ahead and you develop, and by the time your mine is ready to produce, perhaps the market has taken a dump and the prices have fallen way back down, or there's some event that causes a demand shock, like the Fukushima Daiichi accident and Japan coming offline. So if you had spent a lot of capital to develop something in the previous bull market and didn't secure contracts for by the time you got into production, you were kind of screwed. So I think that there's some intelligence and de-risking that comes from a developer signing contracts for sure. The developers that are holding out and have not signed any contracts whatsoever, if they've been able to finance it, perhaps, you know, some of the, like a good example might be Boss Resources that's been restarting the honeymoon. So that's not really a greenfield developer, but they haven't been signing contracts, and they're not going to be producing a ton of uranium, so it's not as big of a deal for them. But you know, John Borshoff with DPLO is sort of infamous for saying like, yeah, we're holding out, we're not signing anything. People keep approaching us, we're not signing anything. But his projects are so far away from actually producing anyways, it's not that big of a statement in my personal opinion. But you know, I give it to the guy, you know, he must be very, very confident. He's the only guy that brought on a uranium mine in the previous market. So the fact that he's holding out shows that he doesn't want to put his company at risk by developing without those contracts yet, but also it's putting a lot of confidence in the future of nuclear and the future of uranium. So, you know, it's risky, but it can pay off for the company in terms of, you know, greater profit margins when they do actually get into production.
I agree. So if you had to build a portfolio today and you had zero exposure to uranium, how would you do it?
That's a hard question to answer because everybody's so different. So whoever is listening to this right now, they're all in very different stages of their lives. They have different capital, investable capital, different levels of investable capital, different risk tolerance based on their own personal psychology or their financial goals with their investments. So it's really hard to say. I can't really say what anybody should be doing. But I will tell you that we included a chart in this month's newsletter that I thought was really interesting that came from Haywood that highlighted an inflection point historically at $60 a pound uranium. And historically speaking, over the past decade and a half, that's only happened a couple of times. Happened on the way up, 06, on the way down in 20, let's see, it fell down to 40, so that would be 08. Then it went back up and back down, kind of right up to Fukushima, following Fukushima, and then just now again in April, and then here. But that spike in April happened so fast, it was above 60 for less than a week. Now we're back above 60. So this inflection point at 60 is where you see across the board in situ valuations. So the valuation of the pounds in the ground of any particular company jump pretty significantly at that point. So they grow as the price is rising and you get to that 60 and they kind of go boop and make a big jump. But what's interesting is not only is that an inflection point across the board for valuations, but that's the point where, historically speaking, explorers and developers really got the high octane stuff and started to significantly outperform the producers. And that's also just kind of a classic resource market, right? So you typically have the smart money, the institutions are kind of the first movers. By the way, that's probably who's been accumulating all the retail puking in the past 8 months. So they position themselves in the large cap stocks, and you can see the performance, you know, of Cameco versus the small caps this year, right? So Cameco's outperformed by a factor of 2x most of the small caps in the space. And you see the large caps move first, and then you see a catch up. And this, I mean, it doesn't happen every time, but it happens very often enough for it to be a thing. Resource investors know this. The large cap stocks move first, and the juniors pull up the rear and go crazy in the middle and the end of the bull market. So at $60 a pound, there's an inflection point for valuations generally, but the explorers and the developers really start to outpace the producers at this point going forward. So I think that's actually what I think is going to happen, and that's what I thought was going to happen even before I saw this really intriguing chart. So if I were positioning now, I probably would be buying the cheaper companies on that metric, on that kind of enterprise value versus pounds in the ground. And, it's not a perfect metric. It's going to give the same valuation to pounds in the ground with a mill built or pounds in the ground with no mill. And that's clearly not an accurate description of valuation, but it's something. It's difficult to value these stocks that may never produce a single dollar of profit, but they're still going to run hard. I mean, you look at some of these very low grade mines in Namibia, these juniors that have a few $100 million of, barely any uranium in the sand, essentially, is what it is. And the stocks are running like crazy. So that's just, the rising tide lifts all boats. Look at share structure. Always look at share structure, because the ETF flows can really move a stock. Of course, that, a low float outstanding shares, tradable outstanding shares, cuts both ways. So when the ETFs are selling, the stocks will tank faster and harder than the ones that have a much larger float. But it just is what it is. I think we're about to enter the phase of the market where the explorers and the developers outperform the big cap producers.
Do you think there's a risk that these guys are going to dilute us to death as the prices go up?
I think that risk is significantly greater in bear markets for the most part. It's one of those things where I definitely notice this because I've been watching this market for so long. The tail end of the bear market, for example, the ASX listed Aussie stocks, just like the dilution was just off the charts. These stocks end up with 3 billion shares outstanding, and then they do a 20 for 1 or a 1 for 20. I always get that mixed up, a reverse split. So the dilution always hurts more in a bear market because these companies are just trying to survive and raising money at low valuations. But once the sector starts running, there's going to be dilution. But, if that money is utilized for something that adds to the value of the company, typically it's worth it. It's not a big concern of mine at this stage in the market.
That's good. And then, do you have anything else that you'd like to share? I mean, anything that you've got off the top of your head? Anything for maybe a new investor looking at this? I know there's a lot of people who gain interest in uranium. They're brand new. They want to jump into the sector. Of course, they buy it when things are full steam ahead, thinking that this move is going to continue. What kind of, I don't know, information can you let them know before jumping in this uranium sector feet first?
Sure. Even though I've already been in this investment for multiple years, I do think it's going to end up being a longer investment than I was originally expecting. So if you had asked me 2 years ago, or a little under 2 years ago, how long this investment could be, I would have given you two scenarios. I would have given you the capital flows stop flowing into the Sprott vehicle, and we have to rely on the sector fundamentals and the supply and demand situation going forward to pull up the price. Or capital continues to flow into SPUT hand over fist, and the price spikes to $150 in the next 8 to 12 months, and then we have to kind of reset. And those two scenarios are unpredictable. But I did believe when the money was really pouring into SPUT and we were seeing big moves in the spot price, that we were going to have a shorter market. And my belief now, and this actually has more to do with the recognition of the improving fundamentals for the growth of nuclear than it does with a recognition of the fact that SPUT has been trading at a exclusive discount to NAV for 6 months. I can't predict the capital flows, but what I can predict is where this market is going in terms of the adoption of nuclear and how this supply and demand situation is going to pan out. The supply is not going to be a surprise. There's no supply surprises that are on the horizon. I don't think we're going to see next gen surprise the market with production in 2026 instead of 2027. I don't think that's going to happen. The Uzbeks are ramping production, but they're already putting out numbers that they expect to double production by the end of the decade. So that's in their 8 or 9 million pounds. It's, insignificant really. When you do the work to model out supply and demand, you can see pretty clearly what's going to happen. And you can even have kind of a wide range. It's like, okay, well, if these mines come online a year sooner than we think, what does that look like? It doesn't matter how you place the supply. There's no flex left. There's just nothing there that's going to come into the market that we can see that is going to surprise on the supply side. Now, I could be completely wrong. I might have to eat my words at some point with that, but I just don't know where it would come from, and it hasn't come yet. And we've gone from $18 to $60 a pound. So I would say for anybody that's interested in this market, make sure you have a long-term vision. That's really, really important. So look at this from a perspective, from a investing perspective for this decade. That's what I would suggest. And take a longer-term approach. Read Gehring and Rosenzweig's recent Q2 commentary. Go read that report. It's called The Golden Foresight. They cover gold, uranium, oil, gas, and copper. And it starts off with this really, really interesting kind of meandering futuristic reminiscence where coming from the first person where it's like, oh, the year is 2029. I'm reflecting on the previous decade. And it's very cool, but it's the way that he thinks, what they think, both Adam and Lee. It's the way that you think. I know that's the way you think with your investments in the long term. I'm the same way. You have to approach this market from the long term because it will disappoint you in the short term and it will surprise you in the short term. You can see positive news flow day over day over day over day, and you can still see the equities move in the opposite direction, and it'll make you want to pull your hair out. And that is just how this market works. But if you have a long-term vision, accumulate when things are weak and do as much work as you can to understand the fuel cycle. Do your own modeling. If you don't have the time to do it, sign up for a service like ours where we do the work and we kind of tell you what X, Y, and Z means for you as an investor. You have to understand the fundamentals for this sector, or you have to take a pure technical approach. And you know what? That's fine with me too. That's just not how I'm playing this. Because I understand the fundamentals so well, I love to buy when the charts look like absolute crap. That's just me personally, because I have a confidence that's going out mid and long term for this investment. But you can't ignore everything I just said and just play the moving averages and volume breakouts and RSI. Just do that. It's fine with me. I don't really care. But the sector is very promising. I really actually love this investment, not because it's what I do and I've built, a career around it, but it's a feel-good investment. I really actually do hope to see nuclear expand in the coming decades. I think it's going to be only a benefit for humanity. I'm pulling for it, regardless of whether or not I make money investing in it. But it's super exciting. The fundamental picture just continues to get better. I sound like a broken record over the past years, but it's true. It just keeps getting better, and I can't really poke holes in it. And believe me that I try. I don't know where that supply is going to come from to stop the price movement. And the UX people and the trade tech people, they're saying the same thing. Their UXC has been notoriously conservative. They've been behind the curve when it comes to forecasting the movement of price, and they are slamming the table now. And this is a complete 180 in how they operate in their proclamations to their readership, which are 99% nuclear utilities. So even the price reporters who are speaking to utilities are saying, you guys, the price is going to go higher. The price is going to go higher. Their numbers, production this year, primary production, is going to be 45 million pounds less than demand. This year, 45 million, they're saying 185 million in demand and 141 million in primary production. Now, there will be a little bit of secondary supply, but there's also buyers that aren't primary. Cameco's been in the spot market a little this year. They're probably going to be in there a little bit more because Kazatomprom is saying they need to buy in the spot market. Some of the producers have been buying. Traders are buying in the spot market. Hedge funds are buying in the spot market. Zuri's buying in the spot market. There's more physical funds coming. It's an absurd setup. I don't know if the S&P is going to crash tomorrow. We have Black Monday part 2. I don't know. I just don't know. But I can look at the uranium charts and I can look at the fundamentals and feel pretty confident about the long term.
I like it, Justin. I don't have any other questions. I think we should probably end it there. If someone wanted to reach out to you or follow your work, how would they do that?
Yeah, thanks, Andy. I appreciate it. Always good to chat with you, by the way. You can be found right here at uraniuminsider.com. That's our website. I'm on Twitter at uraniuminsider. I spend probably too much time there, but I'm trying to spend less time there. overall, but I can still be pretty accessible on Twitter and via email, which you can contact us through the website.
All right, everybody. We'll catch you later. Thank you.